are you all doing? Just going to start the video by saying that I really wasn't impressed with the audio quality on the last video, so I've messed around a lot with my settings and hopefully I've made it a bit better. I've changed the mic position as well, relative to where I'm sitting, which will probably help as well because I kept smashing into the microphone and I couldn't see the keyboard where I had it, so we'll see. But yeah, I've changed the settings and I don't know whether or not it's going to be better. I've done a few test videos and it sounds a little bit better, but we'll just take it as it is and see what happens, because I've tried a few times to make the audio better and it's just not really worked, so we'll just see what happens. Alright, so next important bit, for those of you that don't know, have never come across my videos before, I don't know what I'm doing. I have no financial background, I hold no financial qualifications. I'm simply vlogging my educational journey towards hopefully becoming a successful investor. So this video is for informational purposes only and does not constitute investment advice. Any opinions formed during this video are my own and not recommendations and are subject to change without notice. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions. So with that out of the way, I ended the last video talking about DLNG. I was just looking a bit more actually into their sale leaseback with the mandatory purchase at the end, because it's only trading. Have I still got it on the spreadsheet? Yeah, I have. It's only trading at around 3 times. Has been for a couple of years now. 3.5, 4-ish times simple free cash flow compared to the enterprise value, and I mean that's low, especially when you see what it was like historically, and the debt was always way worse back then as well. As you can see, the book value is improved significantly, tangible book value is improved significantly. They had a lot of debt, I believe. If we go back through the balance sheets, where is it? Total debt. So it was significantly higher. Like you can see here, look, really high compared to where it is now. They've effectively brought down the debt on the balance sheet. Now the way they did that majoritively is they sold the ships to, I think, as a Chinese firm, and then they leased the ships back. Now at the end of the lease, they need to purchase the ships mandatory. I don't know if it's, if I got it here, maybe exact figures. So there you go, 1, 2, 3, 4 ships, and they got 345 million, which they used majoritively to pay down debt, I believe. And then they lease them off of them for, I think it's about 44 million a year, lease them back, and then at the end of the terms, 20 quarterly installments, and one of them's a 10-year one, Arctic Aura. So for the 3 older vessels, these ones here, you can tell this one's newer as well. Look at the price they paid for it compared to the others. So at the end of it, they got a mandatory 20% repurchase price. So 61 million is going to cost them, but that's going to come at different times because these are 5 years and this one's a 10-year. CFO gave another useful data point. After refinancing, DLNG approximately 44 million of annual debt amortized, repaid through, ignores the interest. Right, hang on then, I'm just reading this further. Sorry, I've not got an opinion on this video, I've not read it. So it didn't get through for it and only paid back 61 million later. No, because they've paid back, they've leased it. Right, anyway, it looks cheap, right? But when you look at these ships, they're all 2007, so by the time this is up, they're going to be 20-year-old ships. Now the financial position of this company looks quite good, you know. Only $3.82 a share. I mean, I do everything on EV, so $10 a share, but even then the tangible book value is higher, so the value of the ships is higher. But 20-year-old ships, I don't know. They're not going to have to go out and purchase some ships. I did read further up actually that, was it on here or not? Supposedly the life cycle of an LNG ship is around 30 to 35 years. So if these ships are only going to be 20 years old, then, you know, they still got some time left. And if they've got no debt and their interest expenses come down, well, sorry, I just smacked the microphone. I said I wasn't going to do it because I moved it and I just did it. Yeah, so the interest expenses come considerably down, really. Oh, I don't know. I can't make up my mind on this one, to be honest. And I think the fact that I can't make up my mind on it is probably saying something in itself, you know. This is, I don't know, I thought this was natural gas, but it's not. It's DLNG. This is the, I mean, if you could have bought it down here, then yeah, definitely I would have done it, you know. What did it get down to here? $1 a share. So you're way up. You would have been, you know, you'd be way up already, but can I see it getting back up here? I don't know, because I just think that by the time the finances are good enough on this to, what have I got an alert for? Have I got an alert? What does that do? I don't know. I just think by the time the finances improve enough, then, and they are improving, but I don't know if you're going to benefit from it, because I think they're going to have to go out and buy new ships, and then all of a sudden they're just going to be heavily indebted again. So I don't really know where I stand on it, to be honest, and I think that's probably saying something in itself. So I'm probably going to move on from DLNG. Do I do some discounted cash flow analysis? I've always been about 40% luck on simple free cash flow. Did I ask what revenue forecasts were or not? Let's have a look. Oh, I was on ChatGPT there. I should have been on here. So it must have been on here. Did I ask about the life of a ship, did I? The free 2013 built vessels are younger and ice class, given more runway potentially into the mid 2030s, so maybe 10 years left on them. So there you go. Traditionally, economic lives are 30 to 35 years, but this is shortening due to stricter environmental regulations, higher fuel efficiency, and lower emissions. Accelerated scrapping of vehicles in their mid-20s range in softer markets. So I don't know that it's a softer market at the moment, but what is natural gas doing? It's like an average market, to be honest, doesn't it? Medium price right through the middle. By the early 2030s, 2000 will likely approach or be the end of their commercial viability. Continue trading then possible, lower rates, higher operating expenses, scrap or sold and replaced with modern or second-hand vessels. So that they're going to have to debt up, aren't they? Because I don't think they've got a lot of cash. 41 million in cash. Yeah. There you go. New LNG carriers cost 200 to 260 million, depending on the size. Replacing even 2 or 3 vessels could require hundreds of million in capital. So my issue with this is the potential for having to replace the fleet. It does look cheap on an EV to enterprise. Sorry, it's the same fucking thing. It does look cheap on EV to free cash flow, but I don't know. It's going to be one that I look at in like 6 months' time, and it's gone up, I'd imagine. But for me, 18 to 19 years old, look, did I ask about forecasts? Let's have a look. What forecasts have they given? I don't think they have they? It does not provide traditional. But I think, what was it saying? I'm sure it says here. Okay. New higher rate and time charter, which is expected to accelerate. Continued focus on debt reduction. I don't know, what's revenue been for the last few years? Around about 150 million. What have I put in here? 140 million. Okay. 140 million discounted. Present value of future cash flows is quite low, see. Could you sell this at a multiple of 10 when it's never really been at a multiple of 10 on cash flows? Likely not. 8 maybe, when you look at that, where it is historical average. Let's change that to 8. So 479 million, and it is. Oh, see, that's saying there is some upside. I don't know. I'm not wise enough on this sort of thing at the moment, you know. I'm going to make it blue, like dark blue, which means that I can get it reminds me to go back and check on it, because I think it could be a learning thing for me here. I mean, I cannot see it being up around here. Normally got to buy new ships, but I'll keep an eye on it, and I can use it as a learning thing, can't I? This whole channel is about learning, or my learning journey at least. Hopefully it helps other people that are learning something from it with me. But yeah, I think I'm going to pass on it. Just because my level of confidence in it is just not high enough, you know. I'm sure I read someone wrote something on it. Saying that they thought there's a few people that think it's a buy, and that's this year as well. Look, what's the comment saying? I think I have read this one. In the current earnings release, priorities deleveraging and dividend payments. Nothing about new carriers or anything else, even though they continue advertising themselves as growth orientated. They have pretty small, pretty old fleet and a significant refinancing requirement in 2029. Who's going to be a taker for debt based on this pool of assets in 2029? That's what I mean, see? That's what I feel as well. Nothing organic is likely to happen that is materially helpful without the intervention of the holding company that will require a much larger private company with its own modern LNG carrier fleet. Yeah. 73 vessels of various types, and there's another 54 on order from shipyards. DLNG is fairly small in the context of Dynacom's overall operations. EU and UK sanctions are a huge problem for DLNG unless they can find a workaround. They are on the back foot fighting the EU and UK regulators. Not a good place to be. Continuing to evaluate the potential impact of the sanctions. The author says, don't forget these are specialised ice-class vehicles in a market where such tonnage remains scarce, so even if they need to be redeployed, that scarcity should help. His work for in Russia and Norway. Russia is on the verge of being boxed out. So he's got more. I think at the moment my argument is on the asset side of things. But slowed by the sanctions. I don't even know what the sanctions are, to be honest. Let's read about the sanctions. The EU and UK have placed sanctions. Explain what and why. Guessing it's to do with Russia then. I'd imagine dealing with Russia. Yeah, Russia's energy sector, especially energy exports from the Mao LNG project to reduce Russian government revenues by funding its war in Ukraine. Yeah. Biggest problem with the EU and the UK too. I don't know if it's actually the UK, but there's a large portion of the EU that's heavily reliant on Russian gas. Sorry, just having a drink. Yeah. Prohibit EU persons and non-EU persons from purchasing, import and transferring Russian origin LNG. Okay, specific impact. Two long-term Yamal charters account for 36. Oh, there we go. These charters extended to 2023-24, but face restrictions starting January the 1st. Okay. Operations are currently unaffected. Of course they are. The charters, the restrictions don't start until next year. But acknowledges charters may disagree. Oh dear. See, that makes it worse, doesn't it? Alright. We'll see what the biggest problem as well though, right, is that when did the Russian war in Ukraine start? Russian war in Ukraine. When did it start? February 2022. When did so here, which is what, 24? No, okay. I was just wondering if the multiple drops are heavily then, but no, it was dropping before. Dropped heavily after that actually. Oops, don't want to be dragging a mess around my spreadsheet. Alright, that makes things worse, doesn't it? We'll just leave it, but I will keep an eye on it in the future, because this is a sort of thing, right, that has the potential to... I wonder what that is. Why have I got an alert there? Edit alert. Date is already passed. We've looked at this before. Last year. Did I write anything? No. Okay, bin it. It's an old alert, look. This, like, is anything like that with the sanctions and all that disappears, this has the potential to take off, but are we betting on the the Russia-Ukraine war ending anytime soon? I doubt it. Alright. Okay, we'll move on. We will leave that one there now. Strattec security. I feel like I've looked at this one before as well. Delivers safe, secure and highly engineered access solutions. So keys. Is it keys and locks? I'm guessing. Why is this? Oh, it's rebounded. I'm guessing it's made it into my screener because it's done a 52-week low recently, but rebounded already. Oh, come on, what's going on? Drag it out, open it up. 40 million share repurchase program to buy common stock, lovely. Oh, is there any point in looking at this? It doesn't seem very cheap anymore, does it? In fact, it's almost up all-time high levels. Let's put it in the quick take spreadsheet. What's the STRT? But I think this is a goner. I think there's no point. Let's have a look. Enterprise value. Okay, so it's 4 times. Potentially always traded at that though, that's the problem. Return on capital is good. Historical return on capital. I mean, it's got better, hasn't it? Simple free cash flow has improved, especially from these years. What would this be then? This is now 26, 25, 24. Where was it trading in 2024? Look at that, look. This is a case of, it's traded this low before and it's rebounded before. Things should get better, That's what the argument would have been in 2024. Well, what's that? 3 years. 3 years and almost 300%. I don't think I'm interested in it now. What's it historically traded at? So this one down here, price to free cash flow ratio. Just watch the number on it. So it's always been quite low when things are good. I mean, you bought it down here like 3 times. That is, to be fair, that's COVID. I think we'll leave this one. I just can't see. Currently trading at 5.5 times price to free cash flow, but it's not like it's ever been materially higher. It's had its moments. September 2024, which is when it was negative. Yeah, okay, we'll leave this one. Total debt, low debt, no, that's good, isn't it? Tangible book value 65, but the price is 77. Not for me. Okay, so where are we? NRDS, what's this? NerdWallet. Online tools that provide informational insights. This is a base. This is a hell of a base. The price. NRDS. Ooh, what's happened there? Look. 2 consistent years of 55 million free cash flow, and then all of a sudden 130 million. Something's happened, hasn't it? And is it legit? Was it NRDS? Over this side. SEC NRDS. Interactive data. We want financial statements. That's only 3 months. Everything in mine's rolling 12 months, so we might have to go and have a look in the excuse me, might have to go and have a look in the 10k to figure out what's happened there. 35 million, just materially not much different, is it? Slightly better. Net income's better. Why? Significantly better as well. 20 million better. Oh, that one there. Oh, revenues are 20 million better, is that why? Cost of revenue's gone down on 20 million better sales, no, 10 million better sales, 30 million better sales, but cost of revenue's gone down by 5 million, so there's money there straight off the bat. R&D's the same. SG&A is down almost 10 million, 8 million total. So what's that? 13 million difference. Total costs and expenses. Yeah, 30 million difference. And then you've got 20 million revenues more, see? So total costs and expenses are down and revenues up. Interest income's up mine, so does that mean that debt is up? I'll get onto that in a minute. To be fair, I normally always start on the balance sheet. I just wanted to see why pardon me, still punching the microphone, just gotta get used to it being in a different position. Just wanted to see why the increase in simple free cash flow, but has debt gone up? Let's have a look. What have we got? 56 million in cash, so they've lost a lot of cash. Accounts receivables gone up slightly. Total current assets is down. That's because of the cash. Literally almost all the cash. Property, plant and equipment's gone down. Goodwill has gone up. Not materially, but maybe they've purchased something. Right of use assets, total assets. So what have we got here? 160 million of total assets is goodwill and intangible, so I ignore that. Total liabilities 95. So what have we got? 270, 95, say 100. We've got 170 intangible book value. What's it say on here? 177, yeah. Price is above that though. But there's some form of potential flaw. Depends where this is. Is it the software? It's a dicey thing to be in at the moment with AI, isn't it? Stock-based comp got that. I don't like that. So what's happened there? It's not in here, is it? There's nothing jumping out here as to why free cash flow has gone up 70 million. So it has to be in the 10k. Done a business combination net of cash acquired. So they bought something, have they? Acquisition of a business, yeah, 15.8 million. How much did goodwill go up by? 13 million. Right. Let's find that 10k. I want to know why simple free cash flow has gone up so much. Just have a look at this a minute. I do like looking at these. See what I know we're going off on tangents, but this is all relative. See what can I jump to that? Yeah, I can. See what the internal ownership is. All directors and executive officers. 90%. Oh, this guy here. Tim Chen. Tell me that he's not invested in this then. Right, hang on then. What's it called? NRDS. Selling. Everyone's selling though. Somebody bought in. So I'm just having a look at all the insider stuff. When somebody owns that much, I mean, alright, let's have a look. Get rid of that. Top line owns 9%. Whoever they are. Okay, right, this is sad to see. Last purchase 2024 11. It's currently at 7. So what's that? 50% more. It's currently 8. 50% more ish. Right, what was I looking for? Trying to figure out why simple free cash flow has gone up. Some of it's happened. Has to have happened for it to jump like that. Because in the last quarter, there's no real material difference. Let's have a look. Interactive data. Financial statements. Operations. 150 million more in revenue. Cost of revenue around about what it was last year, and there's a lot more revenue, so that's good. Sales and marketing's way up. Right, what's happened then? What has happened? Here we go. Stock comp's gone down. I hate stock comp, that's a large amount. Look at this year, look. Around about 50% of cash flow comes from stock comp. This year, over 50% comes from stock comp. What has changed? Deferred taxes. There you go, there's a huge swing in deferred taxes. So net income's slightly better, and there's a huge swing in deferred taxes, so it's a one-off. Anything else? So that's not true free cash flow, is it? Because of this. What was normalized? Oh, wrong one. Normalized free cash flow. Difficult to tell with the data that I got. Alright. I haven't even figured out what the business does either, to be fair. Online tools provide information, insights, consumer-driven advice about personal finance. It provides consumer-driven advice about personal finance for its platforms by connecting individuals and small and mid-sized businesses and providers of financial products. Have I heard of NerdWallet? Have a look. NerdWallet. Finance smarter. Oh, so is it like a money supermarket? Is it a comparison site? Yes, it's a comparison site. American personal finance company. Is NerdWallet a comparison website? Major comparison website. Oh, hang on, I got my back at the moment. Trying to move around in my chair is bloody difficult. Major comparison website and financial aggregator. It allows users to compare various financial products side by side, such as credit cards, mortgages, banks, and loans. What have their revenues done? Have they gone up year on year on year? They have. So operating income is way up compared to last year. Yeah, it is. What happened there then? Is it literally that the revenue has just made things better? Oh, I tell you what, my back hurts. Keep moving my hand to try and move the microphone because I'm not used to it being in a different position. Is it literally because you've got 150 million better? R&D's gone down. Sales and marketing's gone up. Gone up by 100 million and they brought 150 million more revenues in from it. What's anyone else got to say on it? Oh, wrong thing. Buy. Despite search challenges, the bottom line remains strong. But we've determined that most of it's not true, haven't we? The free cash flow. Let's have a look at it then, hang on. So, got a huge swing, 50 million swing. And then, so if we're comparing it realistically to previous years, 50 million swing, so that'd be 80 million minus 30 million, it's only 50 million in free cash flow, which all of a sudden makes it way worse. Well, that makes it in line with the previous years on a TTM basis. So it's 10 times already of an enterprise value of 520 million. Right. Alright, I'm not interested, I don't think. It's quite a it's quite range bound though, isn't it, at the moment? From a technical perspective. That is a decent range. %, 8%, 80% in that range. Decent range, but I'm not interested. What else have we got then? Yelp. Technology. Community-driven platform that connects people with great local businesses. Do I know this? I feel like I know Yelp. Okay. Okay. Explain Yelp. Nope. The business. Using all sorts of AI for this. Look, I got Grok, ChatGPT. Now bloody, is this Gemini Google? Crowdsourced local business review and social networking platform helps consumers discover, rate and review local establishments like restaurants. Okay, is it international? Is that why I know Yelp? Is Yelp international? Nominally international, maintaining a presence. That's why I've heard of it. I have heard of it. Right. Yelp. Interactive data. Balance sheet. We'll start there. So I should always start. 100 million in cash. Dropped by 100 million short-term marketable securities. So they had. Oh, what's happened there? They had like 300, effectively 300 million in cash, and they've now only got 200. They've lost 200, and it's all in this. Has debt gone down? No, because they've taken on a revolver. Tell you what though, goodwill and intangibles has jumped by 200 million. So if they bought something for 200 million, it's starting to look that way, isn't it? Right. There's no actual debt, is there, other than the revolving credit facility? What did they purchase? Acquisition, 263 million. Right. New. Yelp. What was it? 262 million? Or 263 million? Made an acquisition for almost 264 million. What did they purchase and what was used to make the purchase? Because it will explain why 200 million's missing from the balance sheet. I wonder. Oh, I haven't got a share count on here. I've got to put the share count on here. Keep forgetting. Hatch, an AI-powered lead management consumer communication platform. 260 million in cash plus 30 million employee retention payments. Okay, payment primarily cash up front, subject to customary adjustments, funded Yelp. So, but they've also taken on a revolver. Let's explain the revolver then. We'll see if we can explain the acquisition, to be honest. Ooh. Acquisition. So 58. How have it say they used the revolver as well as cash? How have they still lost 200 million in cash? In connection with the acquisition, all outstanding capital stock and options to purchase capital stock Hatch were converted to the right to receive aggregate. Okay. We might have to Google the revolver. Search the revolver, not Google it. Oh, they made another acquisition in 2024. How do we find? Oh, I gotta get used to this new mic placement because I feel like I'm not talking into it. I don't know if you can hear me. Notes, revolver. Where's the revolving credit facility? Did goodwill go up? I'm gonna say it did. So look at that a minute. Goodwill, yeah, 200 million more. Pardon me, yawning. Acquisitions, we've read that though. Commitments and contingencies is in this. Revolving credit facility. Outstanding borrowings of 130 million, a weighted average. Okay, so I can't really. I'm too tired. My brain is not working. I'm so tired. So they've always had the revolver, 325 million. They can increase it by 250 million. $130 million outstanding at a weighted average interest rate of 5.5%. Doesn't say why. Purchase obligations. Right, we're gonna have to ask then. Cash has dropped on the balance sheet. Come on, I can't even spell. Sheet by 200 million, but they've also used 130 million of the revolver. What has happened here? Oh, okay. So did 125 million stock repurchase as well. Interesting. Now I want to quickly just pull it in and see what the share count has gone down by. Oh god, wrong thing. I do like companies, not that I'm saying I like this, but I do like companies that buy back stock. Oh god, I keep yawning, man. I might have to make this a short video and call this a night in a minute, because we do have work tomorrow as well. Main metrics, right. Outstanding shares. Oh, they have bought back a few, look. Not many, but they have bought back a few. 90% gross margins come down, slowly come down. SG&A though, slowly come down. Tangible book value $3, current price $3.82. So, oh, what's happened here? Goodwill. Goodwill's gone through the roof. Was it? Has it gone through the roof? Was it? I've forgotten already. I literally only just looked at this. Goodwill, where are we? Up by 200 million. That's what it is. Yep. Tangible book value's dropped massively because Goodwill's gone up. Has it affected cash flows? 182 million. Simple free cash flow down here. Although EBIT's only up slightly. Return on capital is good. Free cash flow yield 70%. Grey on the Z double prime though. I don't understand, there's no interest. Oh, because they bought it with cash and a revolver, I suppose. Simple free cash flow, $3 a share. It's only free, it says 1 times. Really? Oh, wrong thing, hang on. Really? So we've supposedly got a company with very little true debt. You've got 130 million on the revolver. The rest is leases. What's in this other long-term liabilities? A lot of acquisitions. Leases. 60. Can I find that? Control F. Let's see if we can just Google that figure. 60. 626. See if it comes up more and more. No, it doesn't. It's just the ones. Sorry. Right, hang on a minute. Control F. See if we can find it. Other long acquisitions. 2 of 4. One there. Deferred revenue. Okay. And it says a non-significant amount though, doesn't it? Immaterial amount. So it doesn't really break down what other long-term liabilities are. That's annoying. Represents non-current deferred tax liabilities. Oh, okay. Is it tax liabilities? Potentially. Right. What was I trying to look for? Bloody forgot what I was trying to look for already. It was on the balance sheet. It was. One times earnings. Statement of operations. Let's read what's going on. Revenue's up slightly. What is revenue doing long term? I haven't drawn it in, have I not? Yeah, I have drawn it in. Oh, all my figures are wrong because I haven't put the right fucking price in it. Now, let's see what it says. So this is all balance sheet stuff, so this will stay the same. Current price is wrong. There we go. It's no longer 1 times. Fucking idiot. 7 times. Not really interested now. Yield's gone way down. What an idiot. This is... If you've made it this far into the video, right, this is why you shouldn't trust me. Because I do stupid things like that. I was looking for 1 time simple free cash flow. Enterprise value is actually 1.4 billion as well. So all that analysis is wrong just because of that. Nothing about this now looks attractive to me. Nothing. Tangible book value $3 a share against 24. So no real downside protection. Simple free cash flow $3.10 a share. It's almost 10 times. 7 times, 7, 8, almost 8 times. Right, done. Finish for that. One stupid mistake. This is the problem, that one stupid mistake and you've wasted a long time. CCLD CareCloud. Look at this. Oh, do you know what fucks me off about this company, right? I was looking at this before I was doing videos and back when I didn't, not that I know what I'm doing now, but back when I knew less about what I was doing and it was like under $1. And I thought, oh, it looked quite cheap at the time. Little did I know. It's come back down again though, so is it a cyclical company? I don't know. Healthcare. Healthcare, is it? Healthcare information technology company. 27 million free cash flow currently. Trading only at 3 times. Okay. I was going to go to bed, but now I might actually legitimately look into CareCloud. $2.35. Be nice for it to get it down there, wouldn't it? Bloody hell. What's that do? Zoom in. Oh, okay. Oof. Right. Should we look at CareCloud? Get the balance sheet out. We always start with the balance sheet. What does CareCloud do again? I did know because I definitely looked at this before. Health records and practice management solutions. Right. Balance sheet, CCLD, let's go. SEC, CCLD. Hey? It is CCLD, yeah. CCLD. CareCloud. Why did I not find that? Thank you. 42 million shares outstanding. Balance sheet. 3 million in cash. 15 million accounts receivables. 500 in restricted cash. Contract assets, inventory. So very similar year on year. Property, plant and equipment has gone down. Operating leases have gone up. Intangible assets have gone down. Goodwill gone down slightly. So they've had a bit of a write down, but not massive. But I think this is what I didn't like. Like 40% of total assets is goodwill and intangibles. So there's only really 10 million intangible assets against how many shares? Oh, come on. 42.5 million in shares. So that's way down there. Have I got it in here? Did I put CareCloud in the quick take one? I did. Yeah, 24 pence in fucking. So I don't like this. These two here. 50% of assets. Goodwill and intangibles, don't like that. So I mean, it's a technology company, there's going to be no asset downside protection anyway. So your downside protection has to come from the money that they're earning. So statement of operations, let's go there. Revenues up. Core operating costs 30 million. There's only 1 million profit. Restructuring costs. Depreciation's gone up. R&D's gone up by 1 million. Admin's gone up by 1 million. Direct operating costs gone up by 1.5 million. So it's costing more to run this company. Cash flows. What's been added back in then? Stock comp 64. Is that 1,000? Is it 1,000? No, million. 64 million in stock comp. Depreciation. No. That is just the amount, is it? Because there's no balance in thousands. So that is just the amount. It's not in thousands. Let's just check a minute. Financials. Cash flow. In thousands. Operating cash flow. Come on, where's stock comp? 410,000 TTM. Yeah, alright. So it's 64,000. Oh god, my back. 64,000 is not a lot really in the scheme of things. I don't really like it, but it's not a lot in the scheme of things. Not when they've got 3 million so-called and operating that cash flow. Almost all coming from depreciation though. So what's that going to be? Historical software costs, I reckon. Did they pay a dividend? got to the common? Have they got 2 preferred stock? Yeah, not really a fan on preferred stock either. It was cheap, and I remember it being cheap when it was under $1, but now I'm not so interested at this price. What was I going to ask? Just explain CCLD, CareCloud, business model and revenue breakdowns, segments, segmentally, is that a word? And geographically. Definitely looked at CareCloud before. I might have even wrote a blog post on it at the time. I was writing a blog at the time, and I just thought, oh, fuck it, it's easier to do videos than it is to do that. Because I can just record what I'm learning at a time, whereas you do a blog post, you've got to do it all and then write it after the fact. It just takes longer. Somerset, New Jersey. Well, for those of you that can't tell by my accent, I'm from Somerset, England. Founded in 1999, just a cloud-based software, so hybrid, simplifying clinical, financial and administrative workflows for healthcare providers, helps clients maximize revenues, especially through better collections and reduced denials. Okay, key offerings include end-to-end medical billing, eligibility verification, claims processing, submission, cloud-based software, electronic health records, practice management, patient engagement experience tools, AI solutions, so that must be something new. Front desk agents, voice orders, AI does my head in, that shit, when you're trying to talk to someone and it ain't even fucking real. Chronic care management, professional services, implementation, consultant optimization, workforce augmentation, medical practice management, for operational management for select practices. Okay, model emphasizes recurring revenue, 71%, up from 64% from subscriptions. RCM fees, what's RCM? This one. Okay, often. Okay, operates through 2 reportable segments: healthcare, vast majority of revenue, medical, operational. Okay, breakdowns. For 3% year driven by acquisitions and technology enabled solutions. 120% year. Dominant segment, 88% in healthcare and IT. But then there's bits inside that. How do you know which bits are in healthcare and IT? Overwhelmingly US centric. Okay. What happened here then? 3 months last year. Operating income 2019. Was it there? 1980. Oh, net income, not operating income, that's why. Net income 1984. Right. Appreciation's huge. Far outweighs purchase of PP and E plus, because I'm going to say this is a capex for them as well, because it's there last year as well. Capitalized software capex. Why? It could just simply be that their costs to run have gone down over time, but acquisition related intangible amortization, nature of its assets, asset light, moderate ongoing software. Total cash investing outflows for these items were low, 1.2 million won. Non-cash D&A was several times higher. CareCloud has grown significantly via acquisitions. These deals allocate substantial purchase price to customer relationships. These assets often use accelerated methods, leading to front-loaded expenses. This is non-cash charge. That hits net income. Company capitalizes internal software development costs. Modest but steady. Okay. CareCloud is not capital intensive like a manufacturer heavy infrastructure firm. Core operations rely on cloud software, AI tools. Okay, I get that, but when depreciation and capex don't really align, sometimes it's not necessarily a good thing. Accumulate D&A for past investments, especially acquisitions, run higher than current maintenance growth. This is common acquisition. D&A reflects historical spending while capex. Okay, because D&A is added back, profitability. Yeah. If acquisition pace slows and they optimize, D&A can monitor. So acquisitions are currently fundamental to the business model, or they were historically. CareCloud has been an active acquirer for years. Since its 2014, it has completed more than 20 tuck-in acquisitions. Okay, but when does D&A divergence from capex become a problem? Because I'm sure that it is a problem, or can be a problem. Asset light acquisition frequently signals efficient capital allocation, prior investment paying off, and strong free cash flow generation. Persistent extreme divergence can become problematic under certain conditions. Like, when is it not a problem? Okay, much of D&A comes from amortized acquired customer relationships. No need for ongoing replacement capex at the same level. The asset was already paid for at acquisition. Okay, yeah, it makes sense. Asset light model, low ongoing PP&E needs. Growth comes from people, software, and cloud infrastructure. Offshore delivery further reduces physical intensity. Growth phase is lower because growth is via acquisitions. Short term, medium term, as long as the business maintains revenue, client retention, and competitive. What is revenues? Did we check? They are up. Okay. Analysts often assume D&A maintenance capex converge in a terminal year for a steady state business, but it's simplification, not a rule. When divergence becomes a red flag, right? It's probably more I'm interested in, because I can't remember. If the company is not spending enough to maintain or refresh core capabilities, leading to declining productivity, higher future costs, obsolescence, or lost competitiveness. Tangible heavy industries, okay. Revenues or margins start declining. Past investments support current results but without reinvestment. Growth stalls or reverses. Over-reliance on acquisitions to mask a gap. Earnings quality and value distortion. Long-term steady state without convergence. Okay, so they're saying it's largely driven by acquisition-related intangible amortization plus software amortization. It's very low PP&E. It could become a problem if AI and internal development fail to keep platforms competitive, acquire clients churn or underperform post-amortization peak. Okay, alright. Have I got CareCloud in here in the main spreadsheet? No. First thing we'll do, CCLD, get the price right. Otherwise we look like a fucking idiot again. Delete CCLD, CareCloud. Did I copy it? Yeah, I think so. Right. Right, let's have a look. Oh, wrong one. Main metrics. Gross margin. Reasonably steady. SG&A margins down. Tangible book value per share though. I got a funny feeling when I was looking at it last time it was below tangible book as well, which is one of the things that I liked. It ain't now. Interest expenses low though, so there's very little debt. Yeah, there is. There's only 2 million difference between market cap and EV. 4 times. This is what I was looking at, and then it fucking went up. Somewhere in between these 2 years, I think. 4 times. 80% return on capital. So-called safe. Alright. I mean, it used to earn more money as well, mind. Let's see what they're forecasting, shall we? What are CCLD forecasting for future revs? What is as well? Simple free cash flow. Oh, simple free cash flow margins change loads. Change loads. That's because simple free cash flow has increased massively. Oh, is it really? Still don't know that it's cheap though. At $2. It was definitely cheap when I looked at it a couple of years ago, but 128, 132. They reaffirmed it in 2026 Q1. Okay, so there's growth. What has the growth been? Not significant. What will they say? 128. Right. It's very difficult to choose a free cash flow margin though, isn't it? When historically it's changed so much. Here, year on year. 8% it was historically. Right. What should we say? Should we say 100? Should we take them at their value? Like their... I don't like doing that, to be honest. So we're not going to. We'll go 125, which is slightly lower. Could this trade it? Six times. Future simple free cash flow. It has a 12 times multiple, which I think is high. What has it been? Let's have a look. Oh, wrong one. Okay, so it's, for several years now, it's never been below, let's say, 3. So we can adjust our margin up, can't we? 50%, around about 3. What is it trading at? 100 million EV. Simple free cash flow over the next few years, 20 million on this model. Next 5 years. So that's using 12% margin, which is too high, I think. I think that's too high historically. So they had 2 years over that 12. Let's get it more in line with that 8, shall we? Conservative figures. I think that's still too high. There we go. What's it trading at multiple wise? Historically. So at best we can probably expect a 5 times multiple. See, it's overvalued according to this massively. Basically all of my... This is adding the discounted cash flows to a multiple of selling the business in the 5th year or the 10th year. Even then, even in the 10th year, with that extra build up of cash over the next 5 years. And then this one up here is just the figures plus tangible book, but there's no tangible book. So if I look on, so it's like the cash flows plus the assets, which is really low here. What is a Joel Greenblatt multiple going forwards? So if we had a 12% simple free cash flow multiple, which is quite high, again, it's higher than what we were using before, isn't it? So let's take it down to 7. You're looking at a 10 times multiple, it's not cheap. Future simple free cash flow, 10 million compared to 25. These are very conservative values, very conservative, but it takes it more in line with before, and revenues are not really any better than what they were before, are they? In fact, they're going to be worse than what they have been according to their own forecasts. Tangible book value is dog shit. It's probably slightly overvalued, maybe. We'll leave it at that. I'm not going to go any further into it. Done a little bit for it. CareCloud, slightly overvalued. I said, if you can get it down here, get it. Maybe it falls off, we'll see. I would definitely be interested in buying it down here. I didn't actually buy it last time, and in hindsight, I should have done. Just put it as far into the future as I can. So we've set an alert, see if it ever comes back down here. Claims management outsourcing solutions to carriers, brokers, CRD.A. Two different classes then. So look, CRD.A. Does it come up? Doesn't come up. What do Y sheets have it under? How do I get Y sheets back in? Because I closed it. Add-ins. Y sheets is still there. Yeah. CRD.A. Okay, so they do it that way, not .A. There we go. CRD.A. 7 times EV. High. Tangible book value negative, no asset value. Simple free cash flow 100 million, but that's significantly jumped, so something's changed, I guess, considering the stock price has gone up as well, so it could be legitimate. Let's just have a quick look. Quick look at why the cash flow's gone up, and then I'm going to do come on, what was it, Crawford and something. Crawford and Company. Oh, Crawford and Co. There we go. Classic version because I don't like the new one. Interactive data, financial statements. Not interested in this business, by the way. I just want to see why. $12 million. Foreign currency translation gain. Foreign currency translation, foreign currency transaction, designated effective. Okay. Cash flows. That was negative last year. Huge accounts payable swing. 28 million accounts payable swing. Okay. Alright. I'm not going to be interested in this one, I don't think. Is there anything really in this quick take that I would like? Return on capital is pretty good, consistent, 44%. Negative tangible book, don't like. Provides claims manager outsourcing solutions. You're like, oh, it's all over the place. Let's just ask Grog what it does. Let's do this up here. Copy and paste this and change the CRD.A, and what's it called? Crawford and Company. Just see what they do. And then I'm going, because I am tired. It'd be interesting to listen to this back as well and see what the audio quality is like. See if you can hear this squeaky chair. There's any problem with this chair? I got a new chair and it squeaks like crap. World's largest publicly listed independent provider of claims management outsourcing solutions to insurance carriers. Earns revenue primarily on a fee per claim or fee per service basis. Services are delivered through a global network of just one still. Right, layman's terms. Simple terms. End to end. What do they do? God, it's 20 past midnight. I need to go to sleep. I have got work tomorrow. When something bad happens, an insurance company or big self-insured business needs help handling the claim fairly. Crawford steps in as independent expert help. They don't sell insurance, they manage the messy after part. Claim is reported. Someone makes a claim. Insurance companies or employer hires Crawford to handle it. Crawford quickly takes the details, assigns an adjuster or team, starts the process. Experts visit the site, they figure out what happened, how bad it is. For complex claims, decision, Crawford recommends how much to pay and why, helping the insurer decide. So, well, it is an insurer, but it isn't then. They connect people to trusted repair contracts. They manage the repairs. Payment is made, repairs are completed. Two main ways they make money: handling property damage and complex claims, loss adjusting, third party, running the entire claims department for companies. Crawford is the claims fixer that insurance companies and big business hire, so they don't have to do all that complicated, time-consuming work themselves. Fucking hell. Who are Crawford's largest customers? Interesting. I find it strange that doesn't actually give. Lloyd's of London. Behind the scenes service provider. Most policyholders never know Crawford is involved. They just deal with their insurance company. The biggest clients are large insurers and big companies that outsource chunks of their claims handling. Ah, interesting. So they don't get affected. They don't get affected by combined ratios. I know what I'm trying to say, right? An insurer doesn't know what its expenses are going to, so it puts out. An insurer will make policies this year, but they don't actually know what the expenses on those policies are going to be because they have no idea who's actually going to claim. No, Crawford is not directly affected with the way insurance companies are. The key metrics are insurers only. Crawford is not an insurance company. They don't collect premiums or pay claims. They are a service provider that gets paid for handling fees. Okay, that's what I'm trying to get to. Bottom line, in simple terms, Crawford doesn't bear insurance risk. Their revenue is fee-based, not tied to where they are more exposed to how many claims happen and how much insurers decide to outsource. Okay. Do we look into them next time? Is there anything on the quick take that I liked? Let's have a look. I like the return on capital. The return on capital is nice. Simple free cash flow is supposedly 103 million. Was that, did we look at that? Was that a swing in payables? There's definitely a huge swing in payables. There's a 10Q, so where's 10K? Just to back it up, there's an amended 10K as well, look. Oh, pardon me, but yeah, that is a huge swing here. Again, must change that. So net income's higher. That's be something down here. Unbilled revenues, what's this? How's this happened then? 26 million plus that, and then minus. So 30 million revenue was higher, and again the revenue was higher. Oh, sorry, the income. The net income was higher, and then it's got lower 3 years in a row. That's what I'm trying to say. Accounts receivable. So they didn't take 10 million accounts. There's a 20 million swing in accounts receivables. Now there's a 30 million swing in accounts receivables. So that would be 80. What else is there? Swing in payables. So there's a 16 million swing in payables as well. So that's basically getting you there. It's working capital. Acquisitions of property, plant and equipment, capitalized software. 70 million. Okay. 70 million free cash flow, I was going to say, in there potentially. What is it actually? 103. Maybe we'll look at these next time, but I need to go to bed. It's now midnight and I am tired. So thank you very much. I'll see you on the next one. Maybe we'll look into this company. Maybe we won't. I will decide, because at the moment, not really a lot that I like. Multiple's quite high for me. I need to find stuff that's cheaper. Yeah. No tangible book value, don't like that. Did we check quickly? This is on 10k though, and it's not the latest one. Where's the latest balance sheet? Keep saying goodnight, and then I'm just fucking jumping back in stuff. It's because I find this very addictive. I love doing this, and I can't say bye to it as efficiently as I should do. Right. Cash is down. Well, I can't remember what I was looking for now. What did I see in here? No, it was in the other one, wasn't it? Where is the balance sheet? I can't remember what I was looking for now. I'm that tired. My brain's just like, no, I'm not remembering stuff. Intangibles ain't too bad. They haven't changed anyway, let's put it that way. It's only 16.5 million in property. Oh, hang on, there's more there, look. $43 million short-term borrowings. Long-term debt of 150 million. Christ. Alright, maybe we'll look at this on the next one, I don't know. But for now, thank you very much for watching. Please like and subscribe, and I will see you on the next one. Thank you very much. Good night.